in case we had issues with getting everything logged in, but I think we are good to go. And I'm queuing up the live on social media platforms right now. And we should be live on social media. So we'll start with a little bit of housekeeping. Good morning, everyone. My name is Andrew Wall, managing partner of CPA for IT. I'm joined by Eric Chevret, founder of IT360 Financial. And today we're here to talk to you a little bit about salary versus dividends. Now, on the housekeeping side, if you were joining us here live in Zoom, feel free to post your questions in the Q&A, and we'll do our best to answer those as we go through the various questions. If you are joining us on social media, you can post your comments down below, and we will have a team member relay those comments over to us live so we can answer them live. If we miss them for whatever reason, we will do our best to come back and answer those later. So without further ado, let me share my screen here. Oh, I was sharing my screen the whole time. That's me for you. So what I want to talk to you guys about is salary versus dividends, and specifically from the perspective of an owner manager who's trying to figure out how should they pay themselves. And if I'm looking at different types of remuneration, what form is the best for my individual situation? So again, if you're not familiar with our organization, CPA4IT is an accounting firm specializing in service-based business professionals, particularly in the IT industry. And our mission is to help entrepreneurs organize their finances, create wealth, and transform wealth into a legacy. We work with partners like IT360, who are financial planners who can help us with that goal of helping you transform wealth into a legacy. And when we talk about tax planning, that is certainly one of the keys for helping to create this legacy, is making sure that we are optimizing the way you're paying yourself as much as we possibly can, so you pay as little tax as possible while optimizing for your individual situation. Now, when it comes to choosing salary versus dividend, there's a number of factors that you do need to consider. So you want to look at the actual income level as far as not just the salary that you're going to be remunerating yourself, or the dividends, the remuneration that you're going to be paying out of the corporation, but how much money is the corporation itself making? Because there are situations, if you're taking so much of a salary that it generates a loss, if we cannot apply that loss backwards, that is one of the few situations where a dividend might make more sense. You also want to look at and understand the cash flow needs of the business owner and the business itself.
Andrew, I'm sorry, we don't see your screen.
Oh, you're
Sorry.
not seeing the screen. I thought I
No, we're
shared
not
it.
seeing the screen. I'm so sorry
Yes,
for
yes.
interrupting you.
Thank you. I appreciate you letting me know.
No problem.
Okay. So I wasn't sharing my screen the whole time. And
Good. Now we're good.
yeah,
Thank you
and
so
thank you,
much.
Iman. Okay. Thank you for catching those questions, Eric. Um, So, predicted income of the corporation, is it expected to change in the near future? This is another important factor that may affect your remuneration structure. We also want to look at the long-term goals of yourself. As we talk about here, our mission being helping our clients organize their finances, create wealth, and transform wealth into a legacy. What we mean by that is, when we look at how we want to help you achieve a lasting legacy, is to save money inside your corporation, where it's taxed at only 12.2%, allowing you to invest, more money and have it grow faster. And the goal is to get enough money in your company, or companies plural if you do move to a holding company, which is a topic for another day, that you can live off of the return of your investments. Because if you're able to live off the return of your investments, you've got a nest egg that you can pass on to your children, or an important cause, or whatever you want your legacy to be. Now, not everyone achieves that goal, and things often change. Maybe you've gone back to full time. So the long-term goals of the corporation may change over time as well. And while the original goal might have been to build this estate and this legacy, things have changed, and now you're pivoting, and so your strategy might change, and that could affect your strategies as far as salary versus dividends. And then the other thing is our RSP contributions. And I should have modified this slide as well, Eric, for you. Our RSP and EPP
Yes.
contributions important to the owner. And don't worry, I will explain what an EPP is for those of you who are, well, I'll let Eric explain what an EPP is in just a few minutes for those of you who aren't familiar. And then lastly, is CPP important to you, or do you think it's a bunch of hogwash and there'll be nothing left by the time you get to retire? My personal belief is RSP, EPP, CPP, these are good estate planning tools that you should be leveraging. And a great financial planner like Eric and IT360 will put together a whole plan that looks at the macro picture, looks at where you have money saved, and structures it as efficiently as we possibly can. And that's why bringing in team members like Eric is absolutely critical to building that estate that you can pass on. Now, there are a couple of key things that we want to talk about the differences between salary versus dividend. So first of all, a salary is a payment made by an employer to an employee, and this will be subject to payroll taxes, CPP, and in some situations, EI. Most business owners themselves are going to be exempt, and their family members are also going to be exempt from EI, but you're not going to be exempt from CPP or payroll tax. And there are payroll deadlines that get a little bit complicated. We have an entire webinar dedicated to what those deadlines are. But you do need to make payroll remittances, if for nothing else, just the CPP. One of the big bonuses that come along with doing salary is the ability to do a bonus, a director's bonus, that can be paid out actually up to 183 days from your year-end date. And what that allows us to do is to do some tax planning that straddles multiple years and allows us to smooth income. And because of the way our marginal tax system in Canada works, is if you have peaks and valleys, you'll pay a lot more tax than if you just have a straight line. So by allowing us to smooth things over multiple years, this can help us to keep your taxes as low as possible. And that ability to do that bonus 6 months out is only available for salary. It is not available for dividends. Dividends are paid based on a cash basis, which means that if your corporation straddles multiple years, let's say you have a July 31st year end, then you could indeed do a dividend in, the first, 5 months, which would be in the previous year, or the latter 7 months of your fiscal year end, which would be in the next, or the current fiscal year. Now, with the salary, you get that added effectively 6 months, which would allow you to bonus salary. So you would have the previous year, the current year, and now into the next year as an optional strategy. So it leaves a little bit more, a few more strategies available to us, which can allow us to optimize your structure for you. Now, the big thing is knowing and understanding how these things are taxed, because the form of remuneration is very different. One is for an employee and one is for a shareholder. So first of all, if you're not a shareholder, you cannot receive dividends, full stop. In addition, if you have not structured your corporation correctly with different classes of shares for each individual, and you've put multiple members onto one class of shares, say common shares, the way dividends work is they're distributed to that class of shares. And then based off of how many class of shares that each of those person has, like, so if one person had 50% and one person had 25% and the other person had 25%, that's how that split of whatever the dividend will need to be. And so dividends need to be structured in a way, or well, corporations need to be structured in a way so that you have as many doors open to you as possible, which is why when we set up a corporation, we will typically have one common shareholder, and we will have multiple preferred shareholders. Even if we can't do dividends to those other people, or even if we can't distribute or disperse those shares, yet we will still structure it that way so that we have the flexibility and the options down the road. And the reason I say why you can't is there is something about dividends that we will talk about a little bit more in depth in a minute called TOSI, or tax on split income, which effectively makes income splitting with family members through the use of dividends not tax effective. But dividends are going to be taxed very differently because they are paid out of retained earnings and they come off the balance sheet, not the income statement. What I mean by that is that if you have a salary, it's just another expense line. So you have your revenue minus your expenses is your net income, and that's what you pay tax on. Because the salary is an expense, it reduces the net income of the corporation. You pay less corporate taxes, therefore you pay the full freight on personal taxes at your full marginal tax rate. Now, a dividend comes out not on the income statement. So after we have the net income and we've paid tax, that flows over to retained earnings on your balance sheet. And out of your retained earnings is where you will disperse dividends to shareholders, meaning that money has already been taxed once, hopefully at the 12.2% rate. And because it has been taxed once already, you will receive a dividend tax credit personally intended to offset those taxes. And there's something called the theory of integration, which is intended to make it such that there's no benefit of choosing salary over dividends from a tax perspective. However, it's a little bit more complicated than that because with little changes, you end up getting little variances over time. In addition, CPP, which is not a tax, is something you have to pay into your salary that you don't pay into with dividends. And while I personally do value CPP, some people don't, and that is a cash outflow that you will need to make now. So to get a little bit more into the weeds, let's talk specifically about salary and the pros and cons of the salary. So one, it's going to increase your, and this is number one for Eric because he's a big fan of that EPP, but it increases your RSP and EPP contribution rate. Okay, just because you've received a salary doesn't mean you automatically are contributing to EPP or RSP, but it just increases the amount of room that you will have available to it because the RSP is 18% of your salary up to the maximum amount, and the EPP is a little bit more than that, but it again is based off your salary and your years of service, but your years of service are tied to you being an employee, not a shareholder. You also have the ability to pay into CPP, which again, I have put over on the positive. Some of you might move that over to the negative, where we do have it also dictated that you'll have to pay the employee and employer portion of the CPP. We've talked about the salary or bonus that you can use as an additional tax strategy that's available. In addition, income splitting with family members is certainly possible using salary. It is subject to a reasonableness test. So is the amount of money that you've paid your spouse, your children, your parent reasonable for the work that they've contributed? Yes, but there's still not the same requirement as there is with dividends when it comes to the number of hours that are required to work. And we'll talk a little bit about that in a second. So the only downsides to salary is that it is 100% taxable, but that's because you haven't paid any tax inside the corporation. And again, with the theory of integration, that's not really a negative because you're paying the same. It's just in different buckets. There's only a very few set of circumstances where dividend is going to be better than salary from a tax perspective, and that's only if you have underutilized losses. And there are, again, situations where it does make sense to have either dividends or a combination of dividends and salaries, but that is rare. Again, you will have to pay the employee and the employer portion of the CPP, which is now on both sides of our pros and cons. And you will need to set up and make payroll contributions on a regular basis. And one of the biggest cons that we haven't actually labeled here is that the penalties for paying payroll late is one of the steepest penalties there is. If you're even a minute late, it's a 10% penalty. And payroll tax is one of your largest taxes. So that adds up real quick. And if you're multiple years late, they can actually double that and hit you with a 20% penalty. So the big thing with salary is it is a great tool. It gives us a whole bunch of more flexibility and a whole bunch more options, but it is absolutely imperative that you make those payroll remittances on time and understand what your deadlines are, because they can change over the life of your business as well, based off of how much salary you're taking for yourself.
What's great also, Andrew, before you go to the dividend, is there's a bunch of companies that will offer payroll services, for very cheap amount of money monthly, where you don't have to think about it. I mean, either with us or with Andrew, you organize how much you need to work your budget properly, and then you will receive a payroll from that payroll group on a monthly basis, where you put the
Set it and
burden
forget
on
it, so
them.
to speak.
Yeah, exactly. You put that on the autopilot, and they do it for you at a very cheap rate.
Yeah, there's WagePoint, there's NIT, there's QBO payroll. There's a number of payroll services out there that can be utilized, and we'll make the remittances for you to CRA and take care of everything for you. There is some costs associated with that, but those are certainly options out there for people who want to put together a structured plan, set it and forget it, and step back and not worry about it. And that can absolutely make the bookkeeping and the accounting really simple and clean for us, because we're not necessarily worried about tracking director's advances and director spending as clearly, because you've set and done a budget. Now, the reality is most of our clients aren't that proactive. And a lot of the clients are typically, we're dealing with it at year end based on what they've actually taken out. But again, these same strategies still apply. So we can still go with salary. We can prepare a T4 for you. We can give you the amount to pay and set that up for you. So payroll, love it. Great if you're willing to go that route, but there are other options as well. And now dividends. So this is eligible for the dividend tax credit, which means that you're paying lower personal taxes than a salary. But again, keep in mind that that is just because you've already paid some tax on those dividends already. One thing to mention is there's two types of dividends, eligible and non-eligible. Eligible are the dividends that are paid out of money that has been taxed at the general rate, 28%, which would be on passive income or on businesses that are larger than $500,000 in net income. They're going to pay that general rate. And because they've paid that general rate, they get the eligible dividend tax credit, which is more than the non-eligible dividend tax credit, which is for dividends that are paid out of money that has been taxed at the small business tax rate of only 12.2%. But either way, you will get that dividend tax credit intended to offset the taxes you have paid elsewhere. Big pro is that you don't have to pay your source deductions on an annual or monthly basis. So that does improve and make cash flow a little bit better. It's also not subject to a reasonableness test. So you can issue dividends for any class of shares, and you don't have to prove that they've done any work or anything like that, with the exception of the TOSI stuff, which we'll talk about in a
Yes,
second.
very, very important. Yeah.
Yeah, which is really important. And you don't have to pay into CPP, which is again another cash flow potentially benefit, because the cash isn't going out, but of course you're not getting the benefit in retirement either. Now, on the negatives, and big ones here, is it's not increasing your RSP and EPP contribution room. It's also not eligible for certain personal deductions. The most notable one is childcare expenses. There's also moving costs, which is pretty rare these days. But you can't claim either of those against dividend income. So two big strikes right off the bat. And then the third one is that dividends are subject to TOSI, or tax on split income. And I'm sure you're wondering, well, what the heck is TOSI? And TOSI is just general anti-avoidance rules that were put in by the Liberals several years ago. And basically, what it means is if your dividends are subject to TOSI, you're going to pay tax at the highest marginal rate. So it's like a worst case scenario. Even if you were giving salary in a middle tax bracket, they're going to be taxed at the highest marginal tax rate. So instead of basically the government coming in and saying you can't do income splitting through the use of dividends, what they did is they put in TOSI to make it inefficient and ineffective to do dividends. Now, there are a couple of exemptions to TOSI. There are a number of exclusions. And so I've got them listed here, but there's two that are pretty important for the average IT consultant to be aware of. So if you have an individual who's 18 plus, who's actively engaged in the business on a regular, continuous, and substantial basis, which means more than 20 hours per week, you can then they are excluded from TOSI, and you can do income splitting through the use of dividends. In addition, once you reach the age of once the person who is excluded from TOSI, which is the primary shareholder, primary common shareholder, reaches the age of 65, then they can do dividend income splitting through the use of dividends with their spouse, as long as that individual was excluded from TOSI, which would have been based off of this excluded shares, which is you need to own more than at least 10% and less than 90% of income from services not from a related business. So as long as the income is coming from services and you own more than 10%, you're effectively excluded that way. So there are some options for getting around TOSI, but it is a very big factor to be aware of. Now, when it comes to salary and dividend planning, there are a couple of circumstances where dividends are going to make sense. And one is where you have a loss and we can't utilize that. And that typically comes into play in retirement because you're not generating income anymore, but you might still have ongoing operating expenses, in which case declaring a salary and increasing or exacerbating those losses may not be of service to you. So typically, our strategy for our clients, and again, every strategy is unique to the individual client, but when we're talking at a macro level here, our strategy is usually to pay salaries during your income earning years, where you're going to pay into CPP, you're going to increase RSP and increase EPP room. You might even be paying into an EPP. Then once you retire, maybe you're pulling out of an EPP, maybe you've got a multitude of sources that you're generating your retirement income, but any income that you are pulling out of your corporation will typically come out in the form of a dividend at that point. But again, all of this will be dependent on your individual situation and whether it actually is tax efficient in your situation to choose a salary or a dividend. Now, on that note, I did want to give Eric an opportunity to explain what an EPP is for those of you who are not familiar, and why, in Eric's opinion, the EPP is the game changer. If you're sitting on the fence here and you're not sure which strategy you want to go with, salary or dividend, I think Eric's going to explain to you why the EPP is going to probably tip you over and land you on that salary side of the fence. So Eric, without further ado, can you tell us a little bit more about EPPs and why they make a huge difference when it comes to generating wealth and creating a legacy?
Definitely. First, at IT360, we work with a planning tool that we call Neuron that we developed over the last 15, 20 years. And a lot of clients, that question today is a loaded question. I mean, salary, dividend, there's not a day in my life that me or one of my team members don't have that question from one of you. And the real question shouldn't be, should I pay myself salary and dividend if I look at 1 year ahead of me? But if we modelize you paying yourself salary, contributing to CPP, having the CPP contribution paid 50% by the company, giving you the ability to contribute to an executive pension plan. And we compare that guy with the other guy that pay himself dividend, and everything being equal, definitely at the end of your working years, there's a humongous, not a small difference, a humongous difference when we modelize all that. So an EPP, Andrew, is the government give every business the opportunity to set up a pension plan, uh, an employer pension plan for you as a shareholder salary from your company.
Mhm.
The advantage of an EPP, there are five main advantages. The first one is we can put more. So Andrew said that when you contribute to an RSP, no matter if you're 18 years old or 65, it's 18% of previous year's salary. On an EPP, it's a progressive scale. So basically, me, I'm 57. This year, my corporation will put 26% of my salary in my EPP, and it goes all the way to 30%. So rough figure, we put almost 50% more in an EPP compared to an RSP. And it's an expense. It
Yeah.
reduces your corporate tax. The other advantage is, hey, Eric, I mean, I could still contribute to my RSP. The problem with an RSP, on top of the fact that you cannot put more than 18%, the management fees inside an RSP are subject to HST, PST, and they are not deductible in an RSP. With an EPP, Andrew will receive a bill for the management fee, and they're not subject to HST, PST, and it's a deduction for the company, even if it's a personal pension plan. Big kicker.
Mhm.
The other one is the fact that EPP is like a group pension plan. We were able to negotiate with one of the largest pension plan money manager in Canada, where we are not using a retail platform, but we are using an institutional platform. What does it mean for you as a client? An institutional platform, by definition, means lower fees. And on
That's a
top
good
of
thing.
it, it gives us access to alternative investment. So, unless you're an accredited investor, you cannot invest if you are a regular Canadian in infrastructure directly or do private loan and things like that, you know. But when you are part of that huge EPP, there's investment in non-traditional investment like agriculture, the train that they build in Montreal, or back in the days, the Highway 407 in Toronto. So all these things makes a humongous difference between paying yourself salary or dividend. The real question should be, if I pay myself salary and dividend, and you modelize this, everything being equal at retirement, which one is best? And 99.9% of the time during your working years, it will be salary that will be best with flying colors. At retirement, Andrew is right 100%. We flip this to dividend.
Yeah, and it's a no-brainer. And the easiest way, I think you did a great job of highlighting the key benefits of the EPP. And the easiest way I've explained an EPP is it's like an RSP, but for your corporation. So the corporation gets to deduct and reduce the taxable income of the corporation now while you're making those contributions, and the individual is not taxed on it until they take the money out in retirement. So it's like an RSP, but on steroids with a whole bunch more features like Eric has listed earlier. And it's a very, very effective tool. Now, once upon a time, these were extremely expensive and difficult and to set up and to maintain. That has changed dramatically over, I'd say, the last couple of years, Eric, 2 to 5 years most. It has really come down, particularly here in Ontario, thanks to some government rules and legislations that took down some of those barriers that made it more difficult to and time consuming and expensive to set up and maintain. So these wins are available uh, and benefit people exactly like you, small business owners who are trying to organize their finances, create wealth, and transform that wealth into a legacy. And an executive pension plan is one of those great starting points. There's a whole bunch of other things that Eric offers with his team. And we talk about those at some of our other sessions. I encourage you to come out and check out. One of our best ones is probably the top 10 advanced tax strategies for corporations. But there's a whole bunch of other insurance and advanced tax strategies available for those of you who are able to start putting money aside inside your corporation. And I do understand and appreciate that, the economy is a difficult place right now. The one thing is what I'm happy to share back with our community is the feedback that I'm receiving from the staffing agencies that we work with is that the industry does seem to be in a recovery phase. It's a slow recovery, and nowhere near the numbers everyone would love to see, but we're trending in the right direction as opposed to, historically we sat for quite a few years, about 2 years, with a lot of hiring really being on hold. It seems like a lot of those jobs are coming back into the market, particularly for the independent contractor. So that's the positive news. So the jobs should be coming back. I can't help you with the inflation side of things, but Eric can by helping you to make the most of the money that you are earning. So I mean, I guess that's pretty much everything on the dividend versus income. If any of you have any questions, I encourage you to post them here. Again, for those of you who are new to Eric or myself, both of us offer free initial consultations. For ourselves, we do offer paralegal and accounting services, so we can do the incorporation, the bookkeeping, the accounting, the tax, the dissolution, the full life cycle for your corporations. We also have some unique proprietary knowledge and proprietary tools like our benchmarking analysis, our audit representation protection, and a number of tools that we do, much like Eric has his own proprietary tools like Neuron that have been designed. We've been doing this since 1984. Eric's been doing this for a while as well. And what we're doing is we're building tools tailored specifically to meet the needs of you as clients, you as individuals. And I think that gives us a distinct advantage. We do have a question here for you. Regarding industry updates, you just mentioned, Andrew, what's your take on the H-1B changes in the US and what it means for Canada's IT? Not good. For those of you who are not familiar, the US government has put in some new rules on H-1B visas, such to the point where like literally people were getting off of planes who were planning to leave the States on a vacation, getting off the plane and going back because they were worried they would be denied entry back into the US. So if you're on an H-1B visa into the US and you leave and come back, they want $100,000. $100,000, which is insane. Will it have an impact on Canadian jobs? Yes and no. First of all, the largest users of H-1B visas is not Canadians. Well, we do use them a lot. The number one user is primarily India. And I guarantee you they are working right now to get that resurrected and resolved. I think this is another one of Trump's kerfuffles, just like he deported all the South Koreans. And he's going to realize that this is actually a massive mistake and he will roll it back. But that's just opinion, nothing more. I also think that in today's day and age where everything is so digital and we can work from wherever, that what we'll find is those employers who were bringing Canadians down to California or Texas or wherever to work on projects will continue to hire and retain those independent contractors, but just 100% remote. So you won't have to do the travel. You won't have to deal with the H-1B visa. That's most likely what would happen. But again, pure speculation, and I don't know. It could also mean, as Trump does what he does in the U.S., I actually think that Canada is going to serve and survive much better. And so I think our market in so many things, particularly the IT labor market, this is an opportunity for us to shine and to thrive, and to show Americans why they need to be partnering with Canadians and Canadian IT professionals. But again, pure speculation, not really any facts in there as well. And we do have another question here. Can you explain in more detail on balance sheet, income statement, and salary and dividends? I did not hear that part. I had an issue with audio. Sure, happy to explain that. So what I said was dividends come off of the balance sheet, whereas salary comes off of the income statement. And what I mean by that is your income statement is your revenue and your expenses, and your revenue minus your expenses is your net income, and then you pay tax on that. So salary is just another expense that falls on the income statement and reduces the amount of net income of the corporation, therefore reducing the amount of corporate taxes that the corporation pays. Now, at the bottom of that income statement is the net income after tax. That number flows over to your balance sheet and is added to whatever pre-existing retained earnings you have to create your new retained earnings balance. This is the sum of all the income that the income after you have paid corporate taxes on it that your corporation has retained, even if that's not sitting in cash or in stocks or something tangible. That is effectively the value of your corporation. And that is where you issue dividends from. You issue dividends out of retained earnings. They come off the balance sheet. They reduce the retained earnings. And because they reduce the retained earnings, they're coming out of money that has been taxed already. And because of that, you get the dividend tax credit intended to offset those taxes that have been paid already. So hopefully that answers the question for you. What is the difference between CPA for IT and IT 360 service-wise? Pretty much everything.
Yeah.
So I am an accountant and do incorporations. Eric is a financial advisor who provides wealth management services. Or maybe, Eric, I should let you explain what it is you do.
Yeah, exactly. So IT 360 Financial is a planning firm. So basically, we do a budget with you where we realize, okay, how much money you need to pay yourself, and then we will find together the best course of action to accumulate money and implement financial strategy to minimize the amount of tax you pay. So we are a financial planning firm, and Andrew is an accounting firm. We work together. We are partner. You need two of us to, as professionals, to work with you. Andrew doesn't sell financial services, and I don't sell at IT 360 Financial. I don't sell accounting. So basically, we are like
complementary services.
Complementary services.
Yeah. Like the insurance side where we have LMS, ProLink, and Eric does do some insurance and stuff like that, but it's more like life and disability. LMS is like errors and omission. And then we have partners for tax lawyers. We have partners. Like a good business needs a team of financial advisors working in their corner. We specialize in one area, tax. We work with partners like Eric, and Eric does understand the tax implications of the strategies, which makes him a valued partner. He also understands this industry uniquely, which is, again, why he makes such a great strategic partner for us. So IT360 and CPA for IT are two separate companies who are strategic partners. We both serve the same market, and we collaborate on webinars and content, and also on serving the individual needs of clients. So we have a client that we have in common, which we have several, that ability to communicate back and forth with a financial advisor. Like there's stuff that I need at year end to update the T4s based off of EPPs and stuff like that, insurance products. Him and I can have that conversation without having to put you in the middle. Whereas if that's any other financial planner, I'm going to say to you, I need X, Y, and Z. You're going to go and translate that to your financial advisor. He's probably going to give you A, B, and C because he doesn't know that I need X, Y, and Z. And trust me, that happens all the time, particularly with documents based off of the calendar year instead of the fiscal year. And that's just going to add time and cost to your fees. But I hope that answers your question. And we got another one here.
About payroll.
I started to and incorporate a company for a contract job and started getting paid. How do I set up payroll? And since I am part of CPA 4IT, will you take care of the payroll tax, take care of the payroll and pay the tax to CRA? No, we do not do any remittances of any kind for any clients other than ourselves. But we can certainly help you to understand what your payroll obligations need to be, what your deadlines are, how much you need to pay, and help you to be able to make the payments. We can also, if you want to go the route of using a payroll software like a WagePoint or a NIT or a thing, we can help you to get that set up and get that created and go that route. So yes, we can absolutely help you. What I would say is, since this is your very first year, you can book some time with either myself or your account manager. This is usually one of the things that we go over and explain with the clients. Since this is your first year, we may not even declare any salary from your corporation, because if you were full-time prior to starting this corporation, you likely have a whole bunch of full-time employment income already in 2025. We'd want to know and understand how much that is before determining whether we want to give you any payroll from the corporation in 2025. And even though you might take money out, just because you take money out, that doesn't mean we have to do payroll. There's almost always a trick up my sleeve somewhere. And we might say, okay, that's going to become payroll in 2026, because even though you've taken money out of the corporation, that's still less than what you've already got set up as payroll from full-time employment, which might have included a severance and stuff like that. So absolutely critical to talk through your individual situation with your account manager. So feel free to book some time with either myself or your account manager, and happy to go through and figure out what the best strategy for you is and whether we want to use a payroll software or just do annual planning. But that annual planning is important because we do have some deadlines coming up. January 3rd is a big one. And if you don't know what January 3rd deadline is, make sure you check out our payroll webinars that we have in early November, designed to explain what all the payroll deadlines are. And Eric, I think we've come to the last of the questions. Did you have any other questions or anything else you wanted to make sure we shared?
No, but because we have time, what I can do is I would be, I will give everyone, a book about IT 360. I wrote a book last year called The Wealth Algorithm, a financial guide for IT consultant. So Andrew, if you want to send me the info, I will give everyone
a free copy of your book. That's very generous of you, Eric.
A free copy of the book. It's going to be obviously an e-copy, but you will have a lot of information, the way I think, the way we operate. We will cover in that book a lot more than what we cover today, but we do a lot of webinars together, me and Andrew, in the course of the year. So no,
yeah,
my pleasure.
There's a fire hose to drink from, and the only way to do that is one drop at a time. We've made that mistake of getting it too far into the weeds and trying to explain everything in one session. And so, Eric, I know it's only a very small snippet of the services that you offer, but I appreciate you coming in and sharing with everyone. We do have one last question that came in here, which is, will this presentation be viewable online after today? Absolutely. So these webinars are available the minute they end on all of our social media platforms. But what I would say for past webinars, the best place is our YouTube channel. So check us out, CPA for IT on YouTube. We have been doing this content for years. There's a ton of videos out there. And I encourage you to go back and check out some of the ones, including one of my favorites, the top 10 advanced tax strategies for corporations. And I think we're good, Eric. I
Good.
really appreciate you coming out today. We know we'll have you back we've got some more ones. We might be making some pivot. Everyone keep an eye on your events calendar. There might be some updates coming. I'm really excited that Eric actually introduced me to another,
Carlos.
to Carlos, who we have decided to bring in on some of these webinars as well. We've got some clients coming in on some of those webinars as well. And what we want to do is give a voice back to some of the IT consultants. And Carlos has written a book, literally written the book on how to be a successful IT consultant. So we figured, and he's doing a lot on LinkedIn and a lot of social media. So we figured he'd be a great resource to bring in and share some best practices. So I'm not sure if those are up on our website yet, but if they're not, they're going to be coming. And I encourage you to come check out those webinars with Eric, myself, and Carlos, as well as all the technical ones that we'll be doing throughout the year as well.
Thank you very much, Andrew, for inviting me. Thank
No
you,
problem.
everybody. Talk to you
Yep.
soon.
Talk to you soon.
Bye,
Bye for
guys.
now.